Gold is approaching a major liquidity zone right now, and smart money is actively preparing the next massive move. My primary focus today is a high-probability sell setup targeting a massive liquidity pool sitting right below the current market price. Our directional bias is strictly bearish, but there is one specific condition that absolutely must happen first, and if you ignore it, you risk becoming the liquidity yourself.
Let me show you where institutions are actually targeting. $4,170. This is our ultimate sell-side liquidity target. Basically, it's a massive resting pool of sell orders. Most retail traders, they're looking at the completely wrong levels right now, desperately trying to pick a bottom. But the algorithm is engineered to go lower, and it's drawing price straight down to this exact coordinate. Just look at the 4-hour chart. We are seeing incredibly aggressive institutional footprints here. These massive displacement candles have completely shattered previous market structure, leaving huge premium fair value gaps entirely unfilled. The market already swept up major equal highs to grab buy-side liquidity, and now the order flow has sharply reversed. Institutional players are aggressively distributing short positions, hunting those lower discount arrays.
So before we dive into the complex mechanics, here is the exact trading plan for today. We are operating with a strict bearish bias. The primary setup is a short position. We are looking for an entry between 41.85 and 41.95, with our final macro objective targeting that 41.70 liquidity pool.
But here's the question you should be asking. What is actually forcing the algorithm to aggressively reprice gold lower right now? The technicals show us where we're going, but the macro fundamentals? That's the fuel behind these massive price drops. There are two massive forces fundamentally crushing gold demand today.
First, we have the latest Treasury International Capital, or TIC, flows. The data just came in at a staggering $103.1 billion, absolutely smashing the forecast of $75 billion. Foreign investors are aggressively scooping up long-term U.S. financial assets. This massive capital injection heavily supports the US dollar, and a fundamentally strengthening dollar applies intense algorithmic selling pressure directly onto gold. Second, the geopolitical landscape completely shifted overnight. A temporary peace deal between the US and Iran has kicked in, meaning CENTCOM just lifted maritime restrictions for Iranian ports. Over 12.5 million barrels of oil have already safely passed through the Strait of Hormuz. So what does this mean? That safe haven premium that was artificially propping gold up has instantly vanished. The fear is gone, and institutions are dumping their hedges.
Now, let's talk about session timing, because the market operates as a highly precise delivery mechanism. We had standard consolidation during the Asian session, followed by classic liquidity engineering and manipulation during London. This sets the stage perfectly for the New York kill zone. The algorithm is actively using internal structural liquidity to fuel this next leg down.
When you compare the time frames, the alignment is undeniable. On the 1-hour macro narrative, we've got a strong internal liquidity sweep and a devastating breakdown right through the 4,200 level. Then, dropping down to the 15-minute micro execution, it's just consecutive lower highs and lower lows. The flow is strictly bearish, leaving the sell-side liquidity below the Asian and early London lows completely vulnerable. This brings us to exactly where institutions are likely to reload their shorts. We have a pristine 15-minute premium fair value gap sitting perfectly between 41.85 and 41.95. This overlaps with a key resistance zone where algorithmic selling should heavily resume. We just need price to retrace into this imbalance, creating the perfect premium area for sellers to step back in.
But here is the problem. The market is flashing a massive warning signal right now, and this is exactly where most retail traders are about to get completely trapped. Price is currently stalling at the absolute bottom of this 15-minute expansion leg.
Everyday traders look at this stall and think, oh, I need to buy the dip, or worse, they panic sell at the absolute discount extreme. They are literally selling the bottom. Both are critical mistakes. Smart money is doing neither of those things. Institutional capital is patiently waiting for the algorithm to engineer a pullback into premium resistance. They wait to sell at a premium, while retail gets chopped up at a discount.
Because of this, we have a strict rule right now: no trade. Smart money confirmation has not yet appeared. If you enter right now, you aren't trading, you are gambling. We have to let the market deliver the setup rather than blindly chasing it.
To safely execute this, we use a strict 3-step model. Step 1, wait for price to sweep into that premium zone at 41.85 to 41.95. Step 2, once inside that zone, look for a 15-minute bearish rejection or structural displacement lower. we need to see that clear institutional footprint. Step 3, only then do we execute a short entry on the retest of that newly formed fair value gap.
Once that confirmation triggers, here are the hard trade parameters. Entry is dialed in between 41.85 and 41.95. A hard stop loss goes at 42.05, keeping us safely above the recent minor intraday swing high. For targets, Take Profit 1 is our main liquidity pool at 41.70. That's where we scale out half the position. Take Profit 2 is the midpoint of the broader 4-hour discount liquidity zone down at 41.50. This gives us a highly asymmetric risk-to-reward ratio of 1 to 3 or better.
Now, every institutional setup has an invalidation point. For this bearish narrative, that level is 42.10. If we get a clean, sustained hourly close above 42.10 with bullish displacement, this entire setup is completely destroyed. It tells us the algorithm has shifted order flow into a deeper internal retracement phase, and our bearish thesis is dead.
Let's do a quick final recap. Our bias is strictly bearish, fueled by massive US dollar inflows and a total collapse in safe haven demand. But patience is absolutely crucial here. We are waiting for that 15-minute premium retracement into the 41.85 zone. We look for displacement, and then we follow the institutional order flow down to sweep that 41.70 liquidity pool. Always manage your risk.
If you enjoy this kind of institutional-style market analysis using ICT and smart money concepts, make sure to subscribe to ICT Market Theory. We focus on decoding algorithmic price delivery so you can actually understand institutional order flow and stop falling for retail traps.
And if you'd like to trade alongside setups exactly like this one, you can find the FXTM broker account link down in the pinned comment. The liquidity at 41.70 is mapped out and waiting. The only question now is, will you wait for the algorithmic confirmation, or will you fall right into the retail trap?